When we think about investing, we spend so much time analyzing charts, digging through company reports, trying to guess what's next. But what if the biggest threat to your money isn't out there in the market? What if it's the person staring back at you in the mirror? Okay, let's really get into this. This right here is the absolute core idea from Benjamin Graham, the guy who literally invented value investing. His whole point was that after you've done all the homework, the real challenge isn't picking the right stock, it's controlling the right person. You. This isn't a battle of wits with Wall Street, it's a battle for self-control. And hey, if you think just being smart is going to save you, you have to hear this. Sir Isaac Newton, the man who discovered the laws of gravity, lost an absolute fortune in the South Sea bubble way back in 1720. He was smart. He got in early, made some money, and got out. But then he watched his friends keep getting richer and richer, and he couldn't stand it. He jumped back in at the very top and got completely wiped out. The greatest scientist on Earth acted like a total amateur, which just proves that success in investing isn't about your IQ, it's about your temperament. And look, Newton's mistake wasn't some one-off thing. We see this happen over and over on a massive scale. Between March 2000 and October 2002, when the dot-com bubble finally burst, the U.S. stock market lost $7.4 trillion in value. Trillion. Millions of people just let the hype and the panic dictate their decisions, and they paid a massive price for it. So here's the bottom line. We are our own worst enemy. It's our emotions, the greed, the fear, that little voice telling us to just follow the herd. That's what makes this game so dangerous. But Benjamin Graham didn't just point out the problem. He gave us a playbook, a framework to beat that enemy inside us. So let's get into his first big idea, and you'll see how this works. Graham says, before you do anything, you have to know what game you're even playing. Are you an investor or are you a speculator? Because that answer changes everything. And Graham gives us a super clear definition for this. An investment has to check 3 boxes. First, you've done thorough analysis. You've actually studied the business, you know what you own. Second, it promises safety of principle, which means you've done everything you can to minimize the odds of losing your shirt. And third, it offers an adequate return. Notice he didn't say spectacular, just a solid, satisfactory return. Anything else? That's not investing. That's speculating. This really lays it all out, doesn't it? The investor is basically buying a business. The speculator is betting on a number on a screen. The investor is playing chess. The speculator is playing the slots. So just take a second and be honest with yourself. Which one of these columns sounds more like you? All right, Graham's second pillar is just brilliant. It's a way to deal with the market's crazy mood swings. He tells us to imagine the stock market isn't a what, it's a who. He's your business partner, and his name is Mr. Market. There's just one problem. He's a total manic depressive. Some days, your partner, Mr. Market, shows up just bouncing off the walls, totally euphoric, offering to buy your shares from you or sell you more at crazy high prices. Then other days, he shows up in a complete panic, convinced the world is ending, and he's willing to sell you those exact same shares for pennies on the dollar. The intelligent investor gets that Mr. Market's mood is not a signal to follow. It's an opportunity to take advantage of. To see Mr. Market completely lose his mind in real life, let's look at a classic example from the dot-com era, a company called Inktomi Corp. Now, this was an internet software company that in its entire existence had never, not once, made a profit. So back in March of 2000, during one of his most manic episodes, Mr. Market decided this unprofitable little company was worth a jaw-dropping $25 billion. And people, caught up in his excitement, couldn't buy it fast enough. But, what goes up? Mr. Market's mood eventually crashed, hard. By late 2002, he was so depressed and panicked about Inktomi that Yahoo was able to buy the entire company for what worked out to just $1.65 per share. That's a drop of over 99% from its peak. It was the same business, just 2 completely different prices dictated entirely by mood swings. So what's the lesson here? It's simple, but it's everything. You are not Mr. Market's student. He is your servant. You are totally free to just ignore him when he's being a lunatic. You only have to deal with him when his price serves your interests, not his emotional state. Okay, so how do you know when Mr. Market's prices are actually good for you? Well, that brings us to Graham's third and honestly most important pillar of all. This is the central concept in all of intelligent investing. It's called the margin of safety, and it's actually a really simple idea. All it means is that you only buy something when it's worth a whole lot more than what you have to pay for it. That gap, that difference between the real value and the price tag, that's your buffer. That's your safety net. It's what protects you when you're wrong or just get unlucky. See, for Graham, risk wasn't about what company you bought. It was all about what price you paid. As he says right here, paying a low enough price is the ultimate safety net. You could have a fantastic company, but if you overpay, it's a risky investment. And you could have a kind of so-so company, but if you buy it cheap enough, it can be a great investment.
Okay, let's make this super clear. Let's say in both of these scenarios, the business is really worth $100 a share. In scenario A, you pay $95. You're paying almost full price. Your margin of safety is tiny. If your math is just a little bit off or the business has one bad quarter, you could easily lose money. But look at scenario B. You're paying $50 for that same $100 business. Now you've got this huge cushion. A whole lot can go wrong and you can still come out way ahead. That is a margin of safety.
So let's just pull this all together. At the end of the day, Graham's philosophy isn't really about complicated math or crystal balls. It's about building a mental and emotional framework to guide your own behavior. It all boils down to these three powerful rules. Number 1, know if you're buying a business or just gambling on a price. Number 2, use the market's crazy emotions as an opportunity, not as your instruction manual. And number 3, always, and I mean always, demand a margin of safety. And that brings us right back to where we started, doesn't it? Your portfolio's performance in the long run is really just a reflection of your own discipline and your own character. Mastering yourself is the real secret to mastering your financial future. So, the next time the market is going wild, either soaring to new highs or plunging into a panic, and you feel that little tug of greed or fear, just remember this. The most important question you can ask isn't, what's the market going to do next? It's, what am I going to do next? How will you behave?